Monaco64, home of alternative economics and contrarian views. So it's Saturday today. Rudy and I have been out for a walk. I had to carry him the last third of the way. He's still getting used to the lead and the harness. Whoa, what's he doing there, Rudy? Rudy, come down, boy. Rudy? So is it any wonder that he's known as Rudy the Rascal? Well, on a serious note, let's talk about what's happening in the banking system, in the US banking system. And of course, it could spill over into the UK banking system. I think SVB UK also collapsed yesterday. The Bank of England put it into resolution. It's some kind of administration. I'm not sure whether the depositors there are going to be made whole above £85,000. That's how much the FDIC equivalent insurance here is. In the US, of course, is £250,000. So it was an interesting week, of course. We had Silvergate Bank go under, and it was mostly a crypto bank. And to be honest, I didn't think it would trigger other collapses, but it seems to have been one of the things that led to also SVB or Silicon Valley Bank going under. But I wanted to talk to you about John Titus of Best Evidence, and I highly recommend the YouTube channel Best Evidence. John is really, he's really good at looking at the banking system, the monetary system, the legal system as well. And I've had him quite a few times on the channel. The last time was February 22nd, but on February 15th, he did a really good video entitled, "Why is the Federal Reserve Provoking a Financial Crisis?" And after I watched that, I wanted to have him on the channel to talk about that. And that's when I interviewed him. And yesterday as well, there's a guy called Chris Whalen. I think he's worked for the New York Fed. He's a very well-respected bank analyst. I don't agree with everything he says, but he was on Blockworks Macro YouTube channel. And he said the Fed is to blame for the collapse of Silicon Valley Bank. So that's what he thinks. He actually said a few things that were interesting, that the Fed needs to cut rates on Monday and ease with more QE, or else he thinks there will be a contagion of the whole banking system. And I agree with him. The Fed raised rates from 0 to over 4.5% in a matter of just a year. And keep in mind that interest rates had been near 0 and not more than 2.5% since the 08-09 crisis. And keep in mind as well how leveraged or levered the system is. Seeing that the Fed's balance sheet was at $800 billion before the 08 crisis and went up to almost $10 trillion. So I agree with him on that. And so does John Titus, of course. But Chris Whalen's solution is that we need more of the same, more bailouts, more interference in the markets. And he doesn't question, of course, the whole fractional reserve fiat currency system. I think the underlying problem, and I have been saying this since I started this channel in late 2015, is that we have a system that is unhinged, a system that's not based on sound money and sound banking, and that's why we're seeing that. And Chris Whalen is a very good analyst, but he doesn't see that. He's in this cocoon of fiat currency. But be as it may, he's right about what the Fed did. And the problem with the Fed, of course, is that they started massive QE after the 08 crisis. They've kept doing it, and they've kept rates for too low for too long, and they were too slow to react to rising prices, and they're behind the curve. And what I'm surprised about is that this is the big accident, I think, here, SVB. And yeah, what I'm surprised is that it didn't happen earlier. I would have thought it would have happened around when rates were around 2.5% or 3, which is pretty much where the top was in 2018, 2019, when they tried to raise rates again from the cycle low after the '08 crisis. And I guess John Titus agrees with that too. So what is my take about what's going to happen, not just next week, but the week after? Don't forget, the week after, we have the Federal Reserve Open Market Committee meeting on the 20th and the 21st of March. They're expected to raise rates. Up until a few days ago, the expectation was 50 basis points because we've had pretty strong numbers. But now, Chris Whalen, a guy who knows about banking, worked for the Fed, he's saying the Fed has to do something or else this could spread a contagion. And you know how contagion in banking spreads like wildfire. So yeah, so my take, there's two things that I have to say. The first one, yes, the Fed can save the system and do what Chris Whalen is saying. And I'm going to put a link to his video above in the cards. You can listen to it. He thinks the Fed has to step in and bail everyone out again and calm things down. Well, if he does that, of course, or if the Fed does that, that is really gonna put a rocket up real assets, especially gold and silver. And why is that? Well, it will lead the markets and the whole system into the crack up boom that I've been talking about, the hyperinflation. Because people are going to realize the Federal Reserve is never going to be able to control inflation again. And it's not just me saying that. Chris Whalen said that. So yes, that's why it's so important to have physical gold and silver. And the second one also makes it important to have gold and silver, because the other option is for the Fed to do nothing next week and to actually raise rates as they've been telling the markets and investors on the 21st of March. And that, I think, would topple the John Exter pyramid over. And the John Exter pyramid, of course, I've spoken about it many times. It's the inverse pyramid of liquidity. And John Exter always thought that the whole system, this fiat currency system, he called it I owe you nothing's dollar after Nixon closed the gold window. He thought it would eventually topple over, so liquidity would flow from the riskiest asset classes down to gold and silver at the bottom. So that's what would happen if the pyramid toppled over. If it doesn't topple over, the pyramid will just explode, hyperinflate, and the only thing left monetarily will be gold and silver as well. Either way, I think gold and silver are the two places to be, and hard assets as well, for that matter. So with that, I'm going to let you listen to a synopsis of the interview I did with John Titus back on February 22nd. And we spoke about the fragility of the banking system. Check out this week's specials at Miles Franklin. We've got 2022 silver maple leaf coins, only $3.40 over spot. And we've got 2023 kangaroos, only $3.39 over spot. Email info@milesfranklin or call on 1-800-822-8080 and tell them that Mario or Maneco64 referred you.
Well, gosh, what do FHLB advances look like over time? And I looked that up on Fred, and I show it in my video. And you can see that when there's right before the crisis in each and every case, Yeah, there's a big chart. So you have the FHLB advances there in orange. I put as sort of a diamond on the points because they're quarterly, so it looks like kind of this orange barbed wire. And you could see that before each crisis, the big gray bar in the middle being the global financial crisis, the skinny, relatively skinny, gray bar on the left being the .com, the wake of that meltdown, and then the skinny gray bar way over on the right, that's pandemic. Oh my God, I can't feel my legs. Pandemic. Um, right.
Yeah,
That's what that is.
yeah.
So, and you can see that before each of those crises, FHLB loans or the FHLB advances pops up.
I wanted to share another chart that you looked at, and that shows how fragile the banking system was at the end of the third quarter. And it's
Yeah.
the latest FDIC data. And you talk about how we should get the fourth quarter data probably a week from now on the 1st of March. So
Yep.
could you,
That's right.
yeah, could you explain to the viewers, because a lot of times people get confused with interest rates, bonds, and prices, and
Sure.
how that affects securities. And I think what's been happening since the Fed started raising rates, I don't know, about 14 months ago, is that we've seen the worst bear market in not just fixed income securities, but uh, equities as well.
Yeah. Right. Big time. Yeah, you're right. Let's talk about rate increases and the effect because we've lived in a world of zero interest rates for so long that there's basically a generation of traders around who don't know the fundamentals. They don't understand what's going on now. That chart you're looking at, though, it's chart 7. It's the bar graph where the right side of it goes way underwater there to the tune of $700 billion. I think the number is 690 billion. What that is depicting, chart 7, is investment securities on banks' balance sheets. So if you went back to, and don't do it, leave chart 7 up. I'll just mention what it is. But we looked at just a minute ago the consolidated banking sheet of the consolidated balance sheet of the banking industry. And one of the, I think this is the third biggest item, actually it's the second biggest item on the balance sheet as an asset is what's on chart 7, and that's investment securities. So banks, they're free to go out and invest money, but there's regulations on what they can invest in. They can't invest in not in volume. They can't invest in lottery tickets and other things like that. So they invest in investment grade securities, and that's really what you were looking at here in chart 7. These are the bank's investments in securities, and it's basically the banks have invested. I think if you went back to that balance sheet, it's $5.9 trillion. Um, what you're looking at in this chart is the valuation of those assets now. So you look at the rightmost bar going down there below the zero line, the $690 billion underwater. And that's 11.7% decline from the nominal value of those securities. So for example, if a guy goes out and buys a bond for $100, and it declines 11.7%, now it's worth 88.30 And that's what's being depicted on the rightmost bar in chart 7. The reason for that is that all of these investment securities, the investment grade securities like treasuries and like mortgage-backed securities, the way to think of them from the bank's point of view is as a stream of income. And so the example I use in the video is if you borrow $100,000 at 30% over on a 30-year mortgage, if you borrow $100,000 at 4%, um, your monthly payment comes out to $475. And so from the bank's point of view, it's looking at that stream of income, $475 times 360 months, and it sees that, and it's like, well, that's okay. I lent out $100,000 to get the stream of. I bought with $100,000. I used $100,000 to buy a stream of $475 payments. That's how financial institutions look at debt-based instruments. But note that it doesn't really matter what math gave rise to that stream. The $475 is $475. It doesn't matter where that came from. And so now if you think, okay, well, what happens when interest rates go to 8%? How does a bank get a stream of $475 payments in an 8% interest rate environment? And the answer is it only needs to find a borrower who took out a $65,000 loan. $65,000, 30-year mortgage at 8% it produces exactly the same $475 per month stream of income that a $100,000 loan at 4% does. So think about that. I mean, that's a major, major difference. If you have just a rise of interest rates, if they increase from 4% to 8% on a 30-year mortgage, that nominal value of that $100,000 mortgage isn't worth $100,000 anymore. It's worth $65,000 because that's what the bank would be able to get for that investment. It's investment. Once the rates go from 4% to 8%, the bank can't go out and unload that loan for $100,000 anymore, because another lender, another borrower would be like, well, or another investor would say, well, why would I pay you $100,000 for your stupid mortgage when I could just lend the money myself? I could lend $65,000 and get the exact same stream of income. And that's where those huge losses on that chart 7 are coming from. Yeah, I think a lot of the savvier players, people with some moxie in this world, understand that the debt-based monetary system at the US is it's in its last stages. We're in the stage now where it's the lying, the covering up, the punishment of whistleblowers. It's pandemonium. It's just wholesale panic across the board.
That's
And
why I
I
brought
think I
up.
think the BRICS. I think you're right. They're moving to things like gold. They're like, look at us. We're responsible. We're not like those, the U.S. They don't have any gold. They don't have any sense. They're just, look at their deficit. Look at their debt. It's out of control.
Yeah,
That's their move.
that's why I brought up. If you can see here, the John Exter's inverted pyramid. Um,
Yeah.
it seems like there's very little here in terms of not just gold and silver, but actual cash, paper money supporting this whole Ponzi. And I mean, what do you think could trigger it? And of course, we're going to be told that it's something else. But
Well,
yeah,
I think the real trigger will be in the banking system, because that's your monetary system. I mean, in the modern monetary system, you've got your inverted pyramid here, and you've got gold. Gold's no longer part of that monetary system, right? I mean, it hasn't been really since 1971 when Nixon closed the gold window. I think that may change, if is the locus, is the center of gravity of the world moves east, that could very well change. But right now, there's no gold, there's no honesty in the system, at least not in the Western system. My Lord. But what could trigger it in our system, because it's a debt-based monetary system, your money is created by banks. I mean, it's either created by the Federal Reserve at the wholesale level. So the Federal Reserve creates out of thin air, creates Federal Reserve notes. And I don't know what the number is. It's about $2.4 trillion of Federal Reserve notes now. And it creates reserves. And they're sitting at, say $5 trillion. But that's the reserves really aren't money. That's just sort of juice in the wholesale circuit, sort of kind of oil in the system. In the retail side, our money it's really bank accounts. It's checking and savings accounts. And that money is sitting at, depending, pick your figure. Is it $17.5 trillion? Is it $19 trillion? If you back out large scale time deposit, is it 15? It's a big number. Okay. It's between 15 and $20 trillion. That, to me, it doesn't really matter what figure you pick. The point of it is all of that money is created as debt, all of it from top to bottom, from retail to wholesale. Whether you're talking about the Federal Reserve or you're talking about commercial banks, they create money as debt, and that's your problem. So when loans start to go bad, okay, people can't pay back their loans. One of the line items I point out in the quarterly banking profile, that consolidated balance sheet, is the increase of loans that are delinquent. I think it's 30 to 89 days. That number's up like 70%, you know. You're seeing signs of stress. So what's going to trigger it in reality is people not being able to pay the loans back, and loans declining in value for the reasons we already discussed. So to get back to your question, like where do you keep your money? Well, all bets are off. So, you better keep it spread around like a squirrel, because that's what you are. You're no longer a citizen. You're a squirrel. You don't have, if you're voting, I mean, are you kidding me? Voting is what people with the rule of law do. You're a animal in a forest. You better hide your nuts all over the place, man, because you don't know what's coming.
Great. Thank you very much, John. And it was really good to talk to you. And I wish you a good rest of the week.
Thank you. I'm going to go take a bike ride out in the forest right now.
Great. Thank you. Bye.
See ya.